in recent weeks, what has gold proven? Bitcoin's going down and gold's going up. So the jury's out as to which one is the real asset. And I think they both. I think they both are. I think they're completely different. I mean, they've got some similarities in some respects, but to say that one should be the alternative of the other, I really don't think so. I think they sit in an asset allocation point of view. They sit side by side.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 15th through April 22nd, 2024, while supplies last. First, we feature backdated 1-ounce Silver Kangaroos at $3.19 over spot. We also have 2024 quarter-ounce Gold Eagles at $69 over melt. And finally, we're offering 90% constitutional silver at just $2.75 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Now, when it comes to alternative currencies, you recently wrote an article about Bitcoin and how it's been rising in the last year or so, and the Bitcoin ETFs that have come out have been a big reason for this. Can you expand on this, like your thoughts on Bitcoin? Because it seems like there's some people who think Bitcoin is a good thing alongside gold and silver, and some people think it's kind of like a counterfeit alternative currency or a counterfeit currency there. Your perspective?
Well, you know that a lot of bankers, and I'm an ex-banker, having been in banking for 47 years and now retired, a lot of bankers don't like Bitcoin because it's a competitor in a certain sense to the system. If you save your money in Bitcoin, it's not custodied by the bank, and therefore the banks aren't earning any fees on it. So it's not something that the banks officially want to encourage. Having said that, many bankers I know do own Bitcoin privately, even though they would not be permitted to recommend it to their clients. So that's not permitted by their bosses, who will say, we don't think it should be sold to the clients because it's too volatile, it's too risky, it's this, it's that. And obviously to justify the reasons for not recommending Bitcoin, they might throw climate change at you, or they might throw words like Ponzi scheme or backed by nothing at all. I mean, who knows what words they use? They've all got their reasons. I did see an article by I won't say the name of the bank because I think that would be embarrassing them, but by a very large global investment bank, which basically said, we've done a study and we found that by adding just 10% of Bitcoin to a portfolio doesn't improve the risk-reward ratio. And they did the test over 2 years, they said. I wrote to the author of the article and I said, what are you talking about? 10% Bitcoin in a portfolio? That's, who in their right mind is going to put so much in a portfolio? And why do you do a test for a specific 2-year period? There's places you can go to. There's a site, I think it's called Nakamoto.com or something like that, where you can put in any portfolio allocation you like between equities, bonds, and cash, and add an element of Bitcoin of your choice and test it. And you can find out what the Sharpe ratio is. And there's countless studies been done proving that a little bit of Bitcoin in a portfolio, and there the jury's out as to what percentage is the right number, somewhere between 1% and 5% improves your Sharpe ratio. The Sharpe ratio is a risk measurement that portfolio managers to use to make sure you're getting enough sufficient return for the extra risk being taken. So in any portfolio, you want to have a Sharpe ratio which is greater than 1, because if it's less than 1, you might as well leave your money on deposit. So that's a mathematical, I won't go into how it's calculated, but it's a mathematical calculation which can be done. And it's not that the higher Sharpe ratio is the best. That's not true, because a high Sharpe ratio implies higher return and higher volatility. So it's a question of getting that extra return for the volatility being taken. But there's plenty of studies showing that if you add a little bit of Bitcoin to a portfolio, it will improve the risk return. Now, up until now, I think globally, portfolio managers have been very reluctant to put any Bitcoin into a portfolio or to recommend it. But everything must have changed on the 11th of January, 2024. On the 11th of January, 2024, the SEC approved the 10 US Bitcoin ETFs. That's exchange traded funds. Exchange traded funds own the underlying asset. So if you buy shares in the ETF, then they have to buy, in this case, Bitcoin. Those ETFs were launched on the 11th of January, and it was one of the most successful ETF launches ever, attracting tens of billions of dollars into the new ETFs. And also it caused as people put money in, it caused the Bitcoin price to rise from around $40-something thousand to nearly, well, it did go over at $1.70,000. It's now standing in the low $60,000. So I think it's 60, I see on my screen, 62,000 roughly today. So we've had a strong flow up till a week or so ago into those Bitcoin ETFs. Now, what was going on when these ETFs were launched? The various companies which were setting them up had their own individual marketing campaigns, not only to their clients globally, but also to the relationship managers, to the portfolio managers internally. And it would have gone something like this. We're launching a Bitcoin ETF. We think it's a good idea that everybody puts in, and then they name a percentage, 1, 2, 3, 4, 5%, whatever the number is, into the portfolios. And those portfolio managers, some will have done it straight away. Some will have said, I'm going to wait. Some will say, I can't do it till I've spoken to my client. And some will say, I don't believe it. And so, but little by little, money's been going into Bitcoin. And that's why the price at 60,000 is 50% higher than the $40,000 price we saw before they were launched. I think over the months and years which follow, there'll be more and more firms, and that's not just the firms which launch the ETFs, but there'll be more and more firms which accept that Bitcoin is a valid asset class. And that is what has changed on the 11th of January. The fact that it was approved by the SEC now puts it into a category which is not equities, really. It's not bonds. It's not gold. It's not property. It's Bitcoin. So I think Bitcoin has become an asset class which ought to be included in every asset manager's grid. Even if they don't like it, they can put the asset allocation to Bitcoin at 0. That's fine. But I think they should accept the reality that it's become an asset class. And why is it becoming an asset class? Because every man jack around the world who ever had a US brokerage account, or not a US, a brokerage account anywhere on the planet. So anywhere on the planet where you had a brokerage account, you could buy US securities. It's not like an American having a brokerage account at Robinhood. They probably can't buy Indonesian securities. But if you happen to be in Indonesia and you have a brokerage account, for sure you can buy American securities. Everywhere on the planet you can. So everybody on the planet now has a very easy way to get exposure to the price of Bitcoin through the ETFs. Now, I do realize that buying an ETF is not the same thing as owning Bitcoin itself. It's a bit like buying the gold ETF. You're not owning the gold. It's not in your pocket. You can't go and give it to your granddaughter for her birthday. But you do have exposure to the price. So Bitcoin, having become an asset class, I think will get added to the authorized list and the recommended list, or raw recommended list of many firms. And just to show you why that takes a long time, I'll explain. I worked in many banks, and when a new asset would come out, we had two types of lists. The first type of list was called an authorized list, and the second type of list was called a recommended list. These were securities, equities, for example. You were allowed to talk to clients about what was on the authorized list, but it wasn't that it was something which was recommended by the bank. On the other hand, you were supposed to talk to the clients about what was on the recommended list. So if a client said, what should I buy? I should have kept my conversation to the recommended list. If a client said to me, what do you think of Bitcoin? My granddaughter's just bought some. Can I buy it? Then I'm allowed to talk about a Bitcoin. I would be allowed to talk about a Bitcoin ETF and discuss the pros and cons and which one to buy. So to get something onto the authorized list, let alone the recommended list, takes a lot of work. There's many departments involved inside a financial institution. There'll be a compliance department who want to make sure that it's in line with the laws of the country, in line with the rules of the firm or the bank, in line with the financial authority, which defines what level of risk you're allowed to take and who's allowed to take that risk. Because don't forget, in many countries, we've got this notion of qualified investors, i.e. people who've got a certain income or a certain amount of assets can take more risk than those who are not qualified. So everybody's classified as retail. So therefore, compliance has to decide whether it's a retail investment or a qualified investor investment. Then you have the legal department who are checking on custody arrangements, checking on counterparty risk and all kinds of things like that. Then you'll have the investment risk department looking at volatility to see if this is a suitable asset or to what extent it could be suitable, or where, if there's any going to be limits, there should be, of course, any limits placed on it because of the volatility. And then you'll have the discretionary management department looking at whether they would like to have it. Probably not yet, but it'll come. And of course, then you've got the senior management of the bank who will have the final say-so on something which is very controversial. So to get through all these steps takes a long, long time. Meanwhile, all those departments are facing pressure from the relationship managers, from the investment managers, from the client-facing staff who want to talk to their clients about something new. They want to talk to their clients about something new, something unusual, something different. And of course, it's very easy to make a story, good or bad, on Bitcoin. But if you want to spice up the portfolio, what better to have a conversation with the client about, do you think we should have 1% Bitcoin? And then the relationship manager will say what he thinks. But of course, I think a large number of relationship managers and investment managers think that it is not such a bad idea to have a very small amount, because if you have 1 or 2% and the price of Bitcoin does what people expect it to do, I won't say a number because I'm reluctant to make price predictions, but people know what people are talking about on the internet. If it does what people expect it to do, that's going to add several percentage performance to your portfolio returns. Whereas if it doesn't and it goes to zero, it's going to take 10 or 20 years to go to zero. Let's say 10 years. I don't think that's going to happen, but let's say it did. And you've got 1% in the portfolio, well, you're losing 0.1% per year. It makes absolutely no difference whatsoever to your portfolio performance. So on the upside potential is way more in terms of risk reward potential than the downside risk, because if it does go to zero, it's going to go to zero very, very slowly. You'll lose nothing with a 1% allocation, but your 1% allocation could easily become 3% if the Bitcoin price doubles or triples or quadruples.
When it comes to cryptocurrencies, there's a camp that says, well, it's made people aware of alternative currencies and brought more attention to gold. Other people are saying that it's actually taken demand away from gold because, hey, there's another alternative to gold. So your perspective on that going forward, do you think it's going to be positive, negative, or neutral towards the gold and also silver prices?
Well, one of the reasons we've seen money flowing out of the gold ETFs in recent months, I'm not talking about before the ETFs, it was the Bitcoin ETFs. So since the 11th of January, people who held gold ETFs, they will have been looking at it and saying, my gold ETF's doing nothing, Bitcoin ETFs are going up. It's a very easy trade. Your gold ETF is sitting in exactly the same brokerage account as the one which you can use to buy a Bitcoin ETF. It's not like selling your gold ETF at Robinhood, then transferring the money to Coinbase to buy some Bitcoin and opening an account with Coinbase and due diligence and KYC and passports and photographs and all that. That's complicated. This is put in a sell order, put in a buy order in the same place. It's a dead easy trade. So for sure, there will have been, since the 11th of January, when Bitcoin ETFs started trading, there will have been people who will be doing exactly that. But we had net sales from the gold ETFs long before that happened. Those net sales will be going on for at least a year and a bit. So it's not just the Bitcoin ETFs, but for sure, Bitcoin is stealing some of the thunder from gold. But in recent weeks, what has gold proven? Bitcoin's going down and gold's going up. So the jury's out as to which one is the real asset. And I think they both are. I think they're completely different. I mean, they've got some similarities in some respects, but to say that one should be the alternative to the other, I really don't think so. I think they sit in an asset allocation point of view, they sit side by side. And the question is, do you reduce your gold for Bitcoin? I don't think so. I think that would be a very silly move. So whilst the gold allocation currently would be everywhere much higher than the Bitcoin allocations, the Bitcoin allocation in most places will still be zero. Gold allocations in many places will be somewhere between 0 and 5%. I think over time, if let's say your allocation to gold was 5%, for example, I think that gold allocation is going to stay at 5, and the Bitcoin allocation is going to creep up from 0 to a half or 1 or 2. But I don't think it's going to get as high as gold. But eventually, many years from now, it could well do, but we're some way from that, because it's still we mustn't forget that Bitcoin is still a very volatile asset where you can make or lose 10% in a day. And I know that's perhaps one of the reasons why people find it so exciting, because they like to second guess when it's about to go up or down. And of course, if you want to, you can trade options and futures and all kinds of things to go in any direction you want, any day you like, and get leverage with it.
No, it will be interesting to see, because, most people don't even have almost any gold, right? The 5% might be a bit unusual for a portfolio there. So it will be very interesting to see how Bitcoin and gold really play in people's portfolios going forward.
Maybe I'm talking as a Swiss banker. I think traditionally, in recent decades, 3% exposure to gold was kind of the norm in Switzerland. But if you saw 5% in a portfolio, you wouldn't be surprised. If you saw 0, it would be unusual, I think.
Yeah, no, definitely. Yeah, I think I've heard like 0.5% being under 1% right now, maybe on average, but it's so small that if it just increases slightly, as people start to hear more about gold making all-time highs, then it seems like that could make a significant impact on the price.
I definitely think that we're on obviously it's never going to be one way, but I think if you're looking on a yearly basis for many, many years to come, people are going to be looking back at today's price, which is very close to the all-time high, and saying, I wish I had the guts to buy it at that price. I've been investing money for 50 years now. I'm retired, 50 odd years. And my first exposure to gold came 13 years before that, which was the story kind of went like this. I was probably about 5 years old when I went, or 6 years old. I went to my grandfather's house with my mother, and he had some friends around, and he put on the table a bar of chocolate and a £1 note and said, Clive, which one would you like? I took the bar of chocolate, which I now know cost sixpence at the time. So you could have had sixpence in all those 240 pennies in the pound. So you could have had 40 bars of chocolate for £1, but I'd taken the wrong choice. And my grandfather laughed, and all his friends laughed, because it was a great joke to tease a 5-year-old into making the wrong choice. And a year later, I went back to his house, and he tried to play the same trick on me again. But this time he put the bar of chocolate, the pound note, and a gold sovereign, a £1 solid gold sovereign, and asked me which one I want. Well, the coin didn't look very interesting, but I did know that the pound note was the one to take, or I'd get laughed at. So I took the pound note, and my grandfather laughed at it and said, you should have taken the sovereign. But his friends didn't get the joke, because they didn't know what a sovereign was. They'd never seen a gold coin before, because they'd been withdrawn, in the 1930, 30 years before. My grandfather worked for HMRC, the Inland Revenue, the tax authority of the government, so he knew a lot about assets. He even had a share portfolio, which was very unusual back then. So many years later, when I was about 12, 13 or 14, he gave me that gold sovereign and asked me to keep it forever. And I still have it today. I'm 67 years old. I have a few more now. But when I got to 18, I was working in the city of London, and there was a firm called Sharps Pixley. I think they're still around today. Maybe they're part of Digus or the other way around. But anyway, there was a firm called Sharps Pixley. I took it into Sharps Pixley, and I don't know if it was illegal to own gold or not at the time. I can't quite remember, but I asked them what it was worth, and they said, well, we'll give you £15 for it, or we'll sell you another one for £25. Well, I didn't like it. It was quite a huge spread. Don't forget, we had exchange controls, and there was what's called a dollar premium. So to discourage smuggling, it was the price to buy and the price to sell were way miles apart. It's a bit like black market, where you so It wasn't black market in England, but obviously if the price had been closer together, there would be a black market because people would be buying gold at the London price, exporting it to Switzerland, buying pounds in Switzerland with the gold, selling the gold for Swiss francs, buying the pounds, bringing the pounds back to London, buying more gold. That would have been the circular movement, and obviously that was going on illegally. But anyway, I didn't like the price of £15 or £25, so I neither bought nor sold at that time. Of course, today it would be worth £400, and I look back when my grandfather gave it to me, it probably was worth £3 approximately. So the British pound has lost 99% of its buying power if you value it in gold terms, but so has the US dollar. For example, if you go back to 1933 and the day, well, even the entire year, but I remember on the 5th of April, President Roosevelt recalled all the gold, all the money, because gold was the money. So these were the $20 double eagles and the $10 eagles. He recalled them all and asked everybody to hand them in, the gold eagles, hand them in return for paper. So a $20 coin was almost, as near as makes a difference, 1 ounce. Today, to have an ounce of gold, it's $2,381. So the dollar in gold terms has lost 99% of its value. It costs over 100 times as much to buy an ounce of gold as it did in 1933. Now, for those that know, they might remember that well, perhaps not remember, but if they study history, they might know it. In 1934, on the 30th of January, after having seized all the gold belonging to the US citizenship, the government decided to seize the gold belonging to the Federal Reserve. So they passed an act, I think like a banking act or something like that, which invested all the gold owned in the Federal Reserve in the Treasury, which is the government, in exchange for $20.67 per ounce cash in lawful currency, which lawful currency was made into the US dollar. It wasn't gold anymore. It was made into the US dollar. So the Federal Reserve on that date, 30th of January, 1934, got gold, what's called gold notes, which you can see on their or gold account. You can see it on their balance sheet today. It's called gold account, but it's not an account in gold. It's an account in dollars at $20.67 per ounce. They can never and never will be able to allow to claim any gold from that account, even though it's called a gold account, but it's basically the gold which was seized from them by the US government in exchange for paper. The next day, Roosevelt, that's the 31st of January, 1934, the next day, Roosevelt issued a proclamation in which he raised, or rather, I was going to put it the other way, he reduced the gold content of the dollar by nearly 50%. Because don't forget, the dollar was a representation of a certain weight in gold. He reduced that weight by nearly 50%, which meant, putting it into the way we describe it today, it meant the gold price, which on the 30th of January was $20.67, on the 31st of January, it was $35. Or put it another way, it was a devaluation of the dollar by nearly 50% overnight. Now, not only did this piss off the Federal Reserve mightily, who just lost all of that profit, and Roosevelt was quite clear in his proclamation that all of the profit on the gold they just seized from the Federal Reserve now belongs to the Treasury. But it also upset the British, the French, and the Swiss, who were dollar holders, because all foreign dollar holders believed that their dollar represented a certain amount of gold. The day after, it only represented a certain amount of half as much gold. It was still redeemable at that point if you were a foreigner, but not if you were a US citizen, of course. And of course, when we got to 1971, many countries were starting to be quite agitated about the fact that the US government had got far more dollars out there than they had gold to back it. So I think it was the French who were the first to say, we'd like to change some of our dollars into gold, please, and ship it back to France. So they made the arrangements with the Treasury and sent a warship over to New York Harbor to pick up the gold, which as arranged. And they were told very politely, well, we're terribly sorry, you can't actually have your gold, because if you get your gold, it wouldn't be fair to all the other nations who've got dollars. because we wouldn't have enough to give everybody their gold. Therefore, please see President Nixon's, what did he call it? Not the gold, the gold shock, the statement by President Nixon that he just temporarily suspended the convertibility of the dollar into gold for foreign nations. So the French had to sail their battleship away empty without the gold. They came in with the dollars. Obviously, it was electronically transferred, but then they left with the dollars, but they didn't get any gold. And ever since that date, no foreign nation has been able to change their dollars for the gold, which they thought they owned, and which was formally agreed in 1944 in the Bretton Woods Conference, when every nation formally agreed that instead of valuing their currency in gold and making their currency exchangeable in gold, they would make it exchangeable into what would now be the only currency exchangeable to gold, which would be the dollar. So Bretton Woods Conference, America had the most gold. They made everybody agree that all nations would settle their bills in dollars and the dollar would be freely convertible into gold. Well, of course, that didn't last beyond 1971 anyway. And then by 1975, the inflation in the United States was quite high, and there was a lot of public pressure to make holding gold legal again. And so they passed a new law basically to say that Americans can now once again hold gold. And guess what happened? Gold from pre-1933 started to appear everywhere. So if you go on eBay or a gold shop, it's no problem at all to buy tons and tons of those pre-1933 gold eagles, double eagles. So what does that show us? That not everybody obeyed the Executive Order 6102 from Roosevelt on the 5th of April, 1933 to hand in all their gold.
And it's crazy how things haven't changed today, right? Where the U.S. is still using its power through the U.S. dollar to confiscate assets that are held by Russia and all of that. And it's crazy again, how things haven't changed. And it seems like last time, obviously, what was the effect when we took the dollar off the gold standard? We saw a precipitation in the value of the dollar. And it seems like that is a similar thing that may happen today as the U.S. is using its power in this way. Before we let you go, did you have any last thoughts for our viewers? And remind our viewers where they can find you. I know you publish articles on LinkedIn. We'll put a link in the description here so people can check those out.
So I've got nothing. I'm retired. I've got nothing to sell, or no services, no products or anything like that, unlike many people who are here on YouTube. I know you are a fan of gold. So I will say, I don't think anyone should be afraid of buying gold at today's all-time high price. There have been hundreds of all-time high prices in my lifetime, perhaps thousands. And every one of them, looking back, would have been a good moment to buy gold. But of course, if you want to wait for the dip, you can, but you might never get there. And so for those who are interested in gold and silver, I think it's as good a time as any. Bearing in mind what I said at the end about the freedom to own your own assets and what happened with Roosevelt in 1933, people went through a period of 70-something years, 50 or 40 years, when they were unable to protect themselves from inflation, at least not through buying gold. In other words, they had to find other inflation hedges. So while you still can, the window is still open to buy gold and silver if you want to do so. But don't put all your assets in anything, not gold, not silver, not Bitcoin, not the stock market, not property. Be diversified is my message. And if anyone has any questions, you can look me up on LinkedIn and I'll be happy to answer them free of charge.
Sounds good. Well, Clive, thank you so much for your time today, and God bless.
Thank you very much indeed, Elijah. It's been lovely talking to you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 15th through April 22nd, 2024, while supplies last. First, we feature backdated 1-ounce Silver Kangaroos at $3.19 over spot. We also have 2024 quarter-ounce Gold Eagles at $69 over melt. And finally, we're offering 90% constitutional silver at just $2.75 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.